income investor, you may have some questions about your options, like, with so many income products out there, how do you know which one to choose? To get started, we break down the risks and rewards of some common income products in this video. Ready? Then let's go. Income investors typically look for two asset classes for income products: fixed income and equities. Fixed income products like treasury bills, bonds, and guaranteed investment certificates are generally considered a less risky investment than equities because they're considered to be less volatile, which is why their returns have historically also been lower than equity returns over the long term. Equities, like dividend stocks, can have much higher returns, but their volatility risk may also be much higher, making them a lot more risky. Because of this, under certain market conditions, fixed income returns may actually be higher than equity returns in the short term. More on this in our video on income investing and the economy. Real estate investment trusts, or REITs, are sometimes classed as fixed income products because they share some characteristics, but their risk profile usually falls somewhere in between fixed income and equity. Let's start on the less risky side and move our way up. Fixed income investments typically work like a loan. You lend money to a government or company that needs it, and in return, they pay you interest. Treasury bills, guaranteed investment certificates, and bonds are all examples of this. Treasury bills, or T-bills, are low-risk, low-reward investments that tie your money up short-term. They're considered among the safest investments to make because they're issued and backed by the government, so chances that the borrower will default are very low. It is considered very unlikely that a government would default on their treasury bills, which is why they're sometimes referred to as a risk-free investment, though every investment comes with some risk. In the case of fixed income products, inflation and interest rate risk are two important ones to keep in mind because they can pull down the value of your money. T-bills are short-term investments that are issued for 364 days or less, so their inflation and interest rate risk is relatively low. Guaranteed investment certificates, or GICs, can come with short or long-term horizons, anywhere from a month to 10 years. They're not all backed by the government, which means there's somewhat higher chance that the lender may default on their payments. However, GICs are covered by the Canada Deposit Insurance Corporation for at least $100,000 per institution, and potentially more depending on the account you invest from. This means that even if the borrower were unable to repay you, your investment would be protected. You can use their income protection calculator at cdic.ca/calculator to determine the level of protection for your particular investment. Like GICs, bonds can be issued by both governments and corporations, which impacts how risky they are. As a general rule of thumb, bonds backed by the government tend to carry less risk because there's less chance that the issuer will default on their loan. Corporate bonds tend to have a higher default risk, especially when they're issued by smaller companies with unproven business models. However, there are exceptions. Government bonds can also be issued by politically and economically unstable countries with higher default risk. In this case, a corporate bond issued by a large corporation with a proven track record may be a less risky investment. Short and long-term bonds are available, and like other fixed income products, inflation and interest rate risk go up the longer your money is tied up. However, bonds can be sold on the secondary market if you decide to sell them before their maturity date. Decreasing interest rates in the economy actually lead to an increase in the market value of existing bonds, which could mean the bonds may end up selling for higher than the face value, which could lead to capital gains for the seller. This brings us to products outside the fixed income class. Real estate investment trusts, or REITs, are companies that own and operate rental properties on behalf of investors. When you buy a share in a REIT, you're actually buying a small slice of all its properties. Just like owning a real property, it means you can benefit from any capital appreciation they might enjoy long-term and expect to receive a steady income called a distribution while you hold shares. Because REITs are required to pay 90% of their earnings to investors, historically, REITs have produced higher returns than bonds, which is also why they can be riskier. Just like stocks, they trade on an exchange. And while REIT prices tend to be more stable than stock prices, they can still fluctuate. The upside is that your money isn't tied up, And there are stop-loss strategies you can use to help mitigate your losses and pull out of the investment. And the same is true of the last item on our list, dividend stocks. Investors like dividends because they don't tie up their money and they can be reinvested into new shares automatically without additional commission fees. A dividend reinvestment plan called a DRIP makes this easy. Two types of stocks, common and preferred, can both pay dividends, but there are key differences between them. Preferred stocks typically have higher dividend yields than common stocks, and they fluctuate less in price. Holders of preferred stocks also have preferential claim to a company's earnings. If a company is late on its payments, it may be required to pay dividends to preferred shareholders before common shareholders. Common stocks typically have a greater tendency to change price, which is why they come in as one of the riskiest income investments. They can appreciate much more in capital than preferred stocks, but they can also depreciate a lot too, which is why they're considered more volatile. Plus, their dividend yield is typically lower than the dividend yield of preferred stocks. As different income products have a variety of attributes, consider diversifying your portfolio to help balance out some of the risks of income investing. Watch our video on starter strategies for income investors to learn more about how to mitigate risk and maximize your returns. And check out Income Investing in the Economy for more on the impact of inflation and interest rates on your investments. Have more questions about income investing? See our schedule of upcoming webinars and masterclasses for instructor-led content and live insights from industry guest speakers.